Welcome to a conversation on the upcoming AG49-A revisions with John Hancock. We're joined by Doug Koch and Zach Barron of John Hancock. We are so thankful for their time and even more than that, their expertise, because I think really what we're trying to get out of this is how these revisions will impact sales coming up and the conversations you have with clients and illustrations and everything. I'm sorry for the glare. I'm doing my best here. I'll shade my face if I need to. We're so glad to have you. We're going to kick things off a little bit with just some poll questions around your familiarity with AG49-A. So for that, I'm going to turn that over to Nicole Rex, our CEO here at Watermark Life. Thanks so much for really putting this together. We got this together pretty quickly, and this I think is very important. So thank you, Nicole.
Of course, yeah. No, I just think this is a really important topic to talk about right now. Obviously, lots of big changes happening in our industry again. And so I think this is going to be a really good 45-minute presentation just quickly about how we can better understand what our future looks like in the next few weeks and how we should best illustrate. So let's just figure out where you guys, let's get the temperature of you all to see how much you know about this AG49-A so far. And then we can move on from there. So it looks like just a few more people need to answer and we can get rocking and rolling. So it looks just right off the bat that most of you are pretty familiar with the changes coming up, which is great. Maybe not so many of you are familiar with the common misconceptions. So Zach and Doug, please dive deep there for us. But I'll end the polling and share the results with you guys, and then you guys take it from there.
Yeah.
Terrific.
Great. And you know, I think everyone kind of knows here, the AG49-A revolves around illustration guidelines and kind of what you can and can't do on a carrier basis. And, you know, the biggest thing, again, that we're trying to do here is really put this into real world applications. And that's where Doug and Zach come in. So we're going to turn it over to them and we're going to, again, have this conversational. And if you have any questions, raise your hand, send us a chat. And yeah, let's get the conversation started. Doug, Zach, thanks so much for your time.
Well, thanks very much. And thanks for having us, Nicole. This is terrific. We appreciate it very much. You know, John Hancock is one of the few companies that has actually introduced an AG49-A compliant product so far. So we're a little ahead of the game. We want to try to share some of that experience of what we've seen and what we are looking at in our product going forward. Before we go there, I wanted to start with a bit of an analogy and a quick story that might help you to position what is really going on with AG49-A. And if you use this analogy, when for those that know Los Angeles, there's a highway called the 405, and it runs north and south along the ocean. It's 12 lanes on 6 on either side, and it's the slowest highway in America. You average about 4 to 5 miles an hour most of the time on that highway. But if you look to the right, you're going to see that Porsche has put a performance center, a test track that individuals can come to in order to be able to see the performance of that automobile. They realize two things that people buy because of prestige and because of performance. And if they don't show the performance of that car to their prospective customers, they aren't as successful as if they can do that. The irony of that is that when you take a look from the 405, you say to yourself, you're going 4 miles an hour, and here you're buying a car for $200,000, and the only place you can really get the performance from it is on that test track. So AG49 is somewhat similar. AG49 doesn't mean that you don't have the performance that you once had. You have the same performance, if not more, than what we had on our products before. It's just that we've throttled back the way we can illustrate them. Just the same as when you take that Porsche off the test track and put it on the 405, you've got to abide by a 65-mile-an-hour speed limit. Well, they limited the speed limit. So I want to start with Zach. Zach is in charge of our product development area and is responsible for the development of the product that we recently come out with, our accumulation index universal life insurance product that is AG49 compliant. We're going to conduct this almost like an interview, and certainly as you have questions, we can get to those either at the end or if you want, even Nicole, during the presentation, if someone has a question, you want to bring that up, that'd be fine as well. So just so we're on a level set here, okay, so just so we can set the table, what is the real purpose and reason why this was set up, Zach? What was the concern of the regulators as to why they felt they needed it?
Yeah, thanks, Doug, and thanks everyone for joining today. So for background, so the original AG49 came out in 2015, and really it was meant to standardize how max rates on illustrations are run across different carriers for IUL products. There had sort of been not really a standard way to do it. Some carriers use like a 10-year look back, some used a 20-year look back. It sort of was all across the board, so it was really meant to standardize how those max rates were set. AG49-A is really meant to bring into compliance what we've been seeing in the industry, which is carriers using additional charges to fund multipliers or higher caps or anything like that. That's really what we're sort of meant to bring in line here. So for the 20,000-foot view, so AG49-A, we're expecting it to take effect November 25th. This might get moved. There's some talks going on that they might push that back to December. And if that does, that's fine. We'll be effective by December as well. Whatever the date is, it's going to be prospective only. So it's not going to affect enforced policies. So if you have a policy that placed before that effective date, the in-force illustrations will look just like the as-sold illustrations. Nothing's changing there. It's just newly sold policies that will have to comply with the regulation. And then, as I mentioned, the big change is really on illustrations of products that have additional charges, either to support a multiplier or a higher cap or some other sort of bonus. Those accounts won't be able to illustrate significantly better than products and accounts without those features. So on our end, the only thing that's changing, and we'll go through it in the next slide, is the max rate that we can show on an illustration. As Doug alluded to, the caps, the actual multipliers, the actual performance of the product isn't changing at all. We're still going to administer these policies in the same way. You're still going to have that same upside potential. It's really just what we can illustrate on some of these accounts.
So Zach, that really
so for us,
the number one misconception then, Zach, really is that many believed when we're on these calls that you still can't show multipliers. You still can't get the performance that you once did. And that's probably the biggest misconception. Would you agree that we find?
Yeah, exactly. I think that is true that, multipliers were going to go away, that AG49-A was going to, outlaw multipliers. I think that is the biggest misconception. It's not that they're going to go away. Carriers can certainly still offer them. It's really just meant to bring in line that those accounts can't necessarily illustrate better than other accounts.
Great.
So for us, this next bullet is mostly geared towards our protection side. We'll talk about both protection and accumulation. But like our core capped account is where we see most of the funds go, and it's sort of a minimal impact there. Level pays is about 2% on average, the increase, and then single pay is about 4%. And again, we'll go through all the max rates in the next slide. But for us, it's I would say mostly business as usual. I would say most of the accounts is sort of a minimal impact.
Zach, Zach, can I stop you for a second? Before we
Sure.
go there, I think what would be very helpful is if everyone understood how AG49 set caps. And under the new AG49-A, what's the secret sauce? What's the formula that AG49-A requires us and other carriers to utilize that's different in how we set caps before with various products with companies?
Yeah, sure thing. So before with AG49, the old one, there was really sort of one methodology for setting max rates. You'd look back over the last 65 years, you'd apply the current cap, and then you look at every 25-year period over that 65 years. And then you just essentially average the returns of those 25-year periods. So if, let's say, for us, let's say we had an account with a 10% cap, that would come out to a max rate of, I think it's like 6.16. If some other carrier, Pacific Life, let's just say them, if they had a 10% cap, it'd be the exact same max rate. Use that same methodology. So now with AG49A, that's part of it. That's still, that look back methodology is still one component. But for the accounts that have multipliers that illustrate at a higher, essentially net rate, so the max rate times your multiplier and with your charges as well, which we'll show in a second here, there's now sort of an overarching governor as well, as far as what you could illustrate on a non-multiplier, non-charge account. So actually, we'll jump ahead. So let's actually sort of look at that. So we did send out a frequent...
Real quick, let me put you on pause for 1 sec. Just for everyone's information, I put in the chat area a helpful, informative article on this topic that kind of gives you a little bit of the who, the what, and the where. And we're excited right now that Doug and Zach are diving kind of more into the how and the why. But throughout the conversation, I'm going to kind of drop some articles into that chat function if you guys want to click in there at any time or at the end. Sorry, Zach, to cut you off. Go back ahead.
Yeah, no worries. So this is sort of the how and the why, as John just mentioned. So essentially, if we're looking at this chart on the left here, so this is a flyer we put out. It includes all the new max rates that are going to be in effect for our products moving forward. So if we just look at the protection side, so the new max rate in the very top account, the base capped account, that is essentially our no charge, no multiplier account. And it has a new max rate of 7.16. Our capped account, what we call our core capped account, that's the third account there. The new max rate will be 5.54. That one does have a charge and a multiplier. So if we look at the right here, so the base capped account can illustrate at 7.16. The core capped account, when you use the max rate, so the 5.54, it will, in the illustration, include the multiplier, so the 65% multiplier, and the 2% IPC, the index performance charge, and it gets you to essentially the same net rate of 7.16. So when you illustrate those two accounts, they should end up with almost exactly the same premium. The policy values should be similar. That's really what AG49A is sort of getting to. And Doug, I think you mentioned like the misconception there is that we can't show the multipliers. It's not that we can't show them. The account will still show them the effect of the multiplier. It's that it can't illustrate better. So the end result, like your premium solve, the death benefit solve, isn't really going to look better than the base capped account here. So this is, again, we sent out the flyer with all these max rates, depending on when, obviously we still think it's 11/25. It might get pushed back to December. If you have cases that aren't going to make that deadline, I would just encourage you to use the new max rates that we're showing here. That'll really minimize any disruption to your business as you're coming up on year ends. So yeah, just, if you're using those new max rates, there really shouldn't be any change going forward. That's the only thing changing as far as illustrations.
So Zach, just to clarify, it's going to be not a product change, but more so just the cap rate change.
So for our protection products, and then the AIUL 19, which will probably still be available in California come November. I'm going to jump ahead here. So as Doug mentioned, we did launch a new AIUL 20 product that's available everywhere but California and New York. So that one, all of the max rates are already AG49A compliant. So there's nothing there. It is a new product though. We sort of optimized it for AG49A. So on the no charge account, which is now called the select cap account, income actually did improve pretty significantly. It's in some cases 15–20% higher. Typically that's going to be more geared toward the younger ages where you see the bigger improvements. But even our core capped account did see improvements there. Really where you're going to see the impact is the more aggressive accounts, so the enhanced and the high capped accounts. The incomes on those did come down. That's really just driven by AG49A. Those are the ones where, the analogy that Doug made at the beginning, those are the ones where they still offer the high upside potential. They can still have really significantly high returns because they have higher guaranteed multipliers. We really just have that governor, that speed limit as far as what we can show on the illustration. So we did want to continue to offer those. They're definitely going to be a good fit for some customers who are looking for that upside potential. We just can't necessarily illustrate it as aggressively as we did. So that's the new product, and we did launch that. You know, that right now the transition window is to November 24th, which is right before the AG49 date. If that does get pushed back, we can be a little bit flexible on allowing cases after that deadline as well. And then this is looking at the new AIUL 20 product, and I think this is really the example you know, that we show here, which I think is the biggest misconception. So if we look at the top, this is our core capped account at max rate. We see the charges here. It's about $1,100-1,200 a month as far as like the charges here. The enhanced capped, which has the higher charges and the higher multiplier, we still show the higher charges. It's about $1,400 a month. On this one, we do have a higher interest credited. That's the effect of the higher guaranteed multiplier. So we still are showing the multipliers in the illustration. This is right from the illustration. But here is where we see AG49A really coming into effect as on the policy value growth. So the policy value on the enhanced capped doesn't illustrate any better than just the regular capped account. It's actually slightly lower. So that's where you're going to see essentially the net effect of AG49A. That policy value is not really going to grow more quickly. The income isn't necessarily going to illustrate higher, even though you do have more upside potential.
So let me stop you here for a second. This is a very important slide, because what this is saying is that this clearly shows the effect of the enhanced multipliers, the enhanced charge, the greater leverage points that are created with AG49A. But Zach, am I correct in saying when you look at the bottom here, you're showing the same result on the illustration, but what it's actually showing is that if you had your policy statement at the end of those, you know, that period of time, it would show the larger amount. It just wouldn't show it on the illustration. Is that true?
Exactly. Your annual statement is going to show, like, let's say you hit the cap and it's 10%, and then it would be the 10% times the multiplier. You'd show the full credit in the annual statement, and they do still offer that higher upside potential, the enhanced accounts.
Okay. So I guess what I would say to the audience is this. You know, this is my 45th year in the industry, and I worked at the time, I'm going to date myself, but I worked at the time when we didn't have illustrations. You had to sell from a legal pad, and you had to sell from a rate book. You know, I hear producers all the time presenting Index Universal Life, and often I cringe at what they're saying and how they're presenting it. I hear words like, well, your principal is guaranteed. Well, the principal is not guaranteed because you have charges against the principal, and it does have a zero floor, but at the same time, you have to be able to explain it properly. So in my judgment, we have to get beyond the illustration. We have to make sure that the customer truly understands what it is they're buying. And if you were to say the acid test to that would be, can you sell Index Universal Life without an illustration? Most agents can't. And if you learn to do that on the legal pad and explain how this works, we're all going to be far better off than having misconceptions or confusion later on, because attorneys are looking at this stuff. The compliance people are looking at it, and there's lawsuits that are going to be coming if this is not sold properly. We also face the fact that this is a non-registered product. If we don't do a good job as an industry to present this fairly and make sure customers understand it, likely this product could find itself registered, and then that's not a good thing for any of us. So just a little commentary on how this is going to work, and that an illustration simply proves two things. Ink hits the paper, and the minute it hits the page, it's obsolete. It's just a forward-looking document which shows you what this could look like, but there's so many variables within it that can change, that the customer truly has to understand the pluses and minuses of it. One of the biggest things that John Hancock is offering is they're trying to limit more of the variables, the non-guaranteed variables. And the big thing for us is the fact that we guarantee the multiplier, and the full multiplier, not a portion of it, but the entire multiplier is guaranteed, and the charge is guaranteed. Right, Zach?
Correct.
So in that way, you're at least eliminating some of those variables that could be changed by the carrier later on in relation to that. I think you're also going to find that our history of dropping our caps has been very good. And Zach, I'd like you to talk a little bit about our fixed rate and the portfolio rate that John Hancock has earned over the years, and why that's an important aspect for any index universal life insurance product.
Yeah, that's a good point, Doug. So the general account yield, our fixed rate, is really going to become a lot more important with AG49A. So actually, if we jump back to the max rate slide, right? So again, we talked about how now there's sort of two different components to what sets your max rates. So it still has that 65-year look back that the old AG49 had, but now you have essentially the overarching limit of what you could offer on a no charge, no multiplier account. So if you can offer a really competitive no charge, no multiplier account, which is really just derived from the strength of your general account, that becomes really important, because then that essentially flows through to what you can show on your other accounts. So I do think AG49A is really going to shine a light on carriers' general account strength. We think that's definitely a competitive advantage of ours. On our protection products, I mean, we can see here, we can offer a base account with no charge, no multiplier that illustrates above 7%. I think that's a unique advantage of ours in the industry as far as, our competitive general account. I think even more so now, carriers aren't going to be able to rely on, internal charges to prop up some of their indexed account, what they're showing on an illustration. So that's a good point, Doug. I do think, now with these accounts, illustrating very similarly, I want to touch on something you mentioned there, Doug. It really is about educating the clients. Now it's talking about the value proposition of AIUL, which is obviously the 0% floor, some upside potential. Once you kind of get a client comfortable with that, now you can kind of go from there, almost like a VUL, where you get them comfortable with a rate to use, and then you sort of choose their sub-account allocations. Now you get the client comfortable with IUL, and then you talk about the different indexed accounts we offer. One has a little bit more upside potential, one has a little bit more downside protection. That's the way I view it. It's not really being sold on an illustration anymore, sort of like you mentioned, Doug.
Zach, the other thing I think our audience is going to appreciate is there's been a change in standard loan and index loans. Can you explain the index loans and how that's changed and how that could affect premium finance cases?
Yeah, sure thing. So that's the other, sort of key change with AG49A. So index loans, previously the leverage you could show essentially the spread between what's being charged on those index loans and what's being credited. It was 100 basis points before. So let's say the loan charge rate was 5%. You could show a credit on that loan portion of 6%. Now that's coming down to 50 basis points. So again, charge of 5%. You can show a credit of 5.5%. They also did away with any multipliers on top of that spread. So it's really just a flat 50 basis points now. So really those index loans, the upside that you're going to be able to show from even just like standard loans is going to come down quite a bit. Again, I don't necessarily think we do a ton of that, but that definitely is going to impact like premium finance business if they're doing index loans for their rollout, especially when you're taking like a big rollout like that in the early years. So that's definitely something that's going to be impacted. Again, nothing's really changing there as far as the actual upside potential, right? Like the loan charge rates didn't change at all. The index account parameters didn't change. It's really just a more conservative approach to what you can show there.
So practically, what does this mean? It means that when you, under AG49A, when you use the standard loan, you might get an income of $100,000. You show an index loan with some carriers, it can go up to $120,000. Magically, there's another $20,000 in the illustration. that gap is maybe going to go from 100,000 to maybe 102,000. You understand? So the index loan is not going to give you that lift that you once saw in an illustration. Also, again, when you're showing either a more aggressive multiplier or charge, it's going to get throttled back. And most premium finance illustrations that we see, they throw the kitchen sink in there in order to try to get the rollout period to come as soon as they can get it. So they're using very, very aggressive tranches with, you know, very aggressive index rates on, you know, loans to be able to juice it up as best they can. Now, what does that mean? It means that your rollout year, Zach, does it not, could be contracted by a few additional years compared to what we might have before. So the lender means that you're going to have that interest paying on that loan a little bit longer before you have enough money to roll out of the loan. Is that true?
Exactly. As far as illustrating it, obviously nothing has changed as far as what the actual upside is, but yeah, we can't illustrate it as aggressively as we did.
And again, with premium financing, you know, the lenders are looking at illustrations. Okay, that's what they have to go off of. So understand that that's what they're going to be judging their loans on more than what an insured might look at. You understand? Because they're not loaning money off of that. So be cognizant with the fact that it is going to change some of the more aggressive and thankfully I'm kind of pleased about that, because you don't want someone who has a complicated product like Index Universal Life, and then they're gonna borrow the money to fund it. It's hard enough to understand index, much less the loans that are created and how that all works. It requires you to really make sure that you're spending the time with the customer in explaining both aspects, and that they're being done in a fair and equitable way. So, so when it comes to charges, let me just ask this, Zach. We talk about, you know, the options budget and where charges are coming from the option budget. How's that work for Hancock, and what are we seeing elsewhere?
Yeah, good question. So for us, you know, all of our index account parameters, all of our options budget has always really just come from our general account yield. We don't bake any additional charges into like supplement our options budget. Obviously, certain accounts we take an additional charge, and that helps us fund the multiplier. We can still offer that, but we never, you know, baked in any internal charges to the product to support caps or anything like that. Some other carriers, it's possible they do that. That's sort of speculation on our ends, but right, like all of ours has really ever just come from our general account, and I still think that's going to be a strength of ours. If carriers were doing that, whereas baking it into like internal charges, that is something AG49-A also did address. They essentially said you can't do that anymore. So really all of the index account parameters essentially have to be funded by your general account now. So that's another key feature where having a strong general account is going to help you.
Okay, so let's talk about this date for a second. It either is going to be the 25th of November or it's going to be the 14th of December, but it's going to be one of those two. Right now, we're planning on it being the 25th of November. So let's talk about what you're selling now. If you're selling a product now in California called our AG49-A product that's there now, it has to be illustrated on the basis of AG49-A on the 26th of the month. So what we would do is we're going to have you sign a new illustration on the 26th that you wouldn't have to sign on the 24th. Now, some carriers are allowing you to still sign the old illustration and still use that. Us and some other carriers are not. And the reason what we're not doing that is we want to make sure that you have that new illustration signed, it's compliant, and we don't have to go back. Some carriers may not allow you, will allow you to use the old signed illustration, but the risk there is that if the compliance department says ultimately know we need those signed, you may have to go back after several months and have them get that signed again. And that really is tough for an agent. So we're taking the view that you need to sign it. Now, what's unusual here is this. On the AG49 product we have now in California, and we haven't had the new one approved yet, the 20 is not approved yet. California, as you know, is a very difficult state to get things approved based on what the rest of the country does. We expect it to be sometime in December. But here's the thing that's really great. The difference on the 1 year point-to-point capped, which is our most popular account, it comes with the 55% multiplier on our current product, and it has the 1.98% charge. That currently illustrates at a 5.67% maximum rate. Under the new AG49-A requirement over that product, it dropped 4 basis points. Let me repeat that. It went down 4 basis points. So if you're going to illustrate accumulation index universal life with John Hancock using the 19 product, just run it at 5.63, and that way you won't have to redo it on the 26th of November. It only has come down 4 basis points. As we go through this, Zach, and we see other carriers, and we're going to see fast and furious here, other carriers launching their version of this product or compliant products in the next month, correct?
Yeah,
I think as we see that, we're going to see where we stand. We were the second carrier to introduce an AG49-A compliant product. And we're going to see where we stand in relation to the rest. But we think we're going to end up pretty good. And the reason why we think we're going to end up pretty good is because of that, what Zach said before, the underlying portfolio. Because in index products, the two things that you've got to be looking at is what's the carrier earning on the portfolio rate, and then what are they paying for the hedges? And the facts are, this is demonstrated by the fact that our fixed account, which comes with no charge, it's a great place to go to a timeout. You think the market's so overheated and you don't want to pay a charge and you want to take a timeout. On our protection index universal life, I believe, Zach, it's 4.1%. Is it not? On the fixed rate? And our accumulation is 3.7. Isn't that true?
Yes.
So I want to ask you, if we weren't earning it, could we pay it? So take a look at what some of the other carriers are offering there. That's kind of, in my judgment, the acid test for what you have as an underlying rate of portfolio. Take a look at some of the carriers that are 2% or less. And the reason we've been able to do that is we haven't diluted the portfolio by taking a lot of premium in excess of the targets. So we haven't done a lot of excess premium financing cases that have been ridiculous to dilute the portfolio. And that's one of the reasons why we're able to stay where we are with that. So some of the carriers have not looked at that. And so that's something I think that, again, if you need a timeout and you need a fixed account there, those rates are awful attractive based on the fact of what we're doing there. Any commentary on that, Zach, and as to how we're able to do that?
Yeah, that's a really good point. I think that is a good, litmus test across carriers, is just comparing those fixed account rates, because that really is just a sign of what you're actually earning in your general account. As far as how we can do that, it sort of goes back to, our protection UL story, which, in our portfolio, we use what we call alternative long duration assets. So in some cases that's real estate, it could be power and infrastructure. We always talk about investing in timberland. That's sort of a unique feature of ours. I would say we have more expertise and experience in investing in those alternative long duration assets. I would also say that that's really helped us protect our general account yield over time. And that's the other thing you sort of mentioned. We haven't really been in the kind of crazy premium finance space. It's also, we haven't really ever, been in like the high early cash value space. Part of the reason for that is because, these alternative long duration assets, we expect to hold them for 30, 40 years. They're less liquid, but they do give us that higher yield over time. So if you're willing to have that trade-off where, In some cases, our products don't offer the highest early cash value, but over time, we think they can offer significantly more value because of, again, the strength of our general account.
So we're almost up time. We want to get some questions here, but I did want to add one other thing. Nicole and company are going to pay you your compensation. Whatever she pays, God bless you and her. That's your business, and I know that they're very competitive as what they pay. But John Hancock is going to pay you an additional 10%, 30 days after you sell the contract, if you add vitality to the rider, to the policy. You can do that using bronze, which the difference in the illustration using bronze and not adding vitality is $24 a year. It's nothing. We'll pay you an additional 10% compensation above what Nicole did 30 days after you place the policy, sent directly to you. So we're doing that to incent you to look at vitality and to be able to talk to your clients about it in a meaningful way. And again, if they take bronze, anything they do in the future is a plus. If they don't do anything, the illustration is not necessarily going to change. So that's where we are with that. I just wanted to make sure, and certainly we could spend another time talking about vitality, its benefits and advantages and what that does. But I want to turn this back to John and see if we have any questions that we might want to field from the field.
Yeah, Doug, I do have a question myself real quick, if you don't mind. You mentioned earlier that you thought some of these changes might have actually been necessary, and that, maybe things needed to be reined in a little bit. How kind of crazy was the landscape before AG49 went into effect? I think that was back in 2016, right?
Well, that's when it first came about, but
yeah.
What happened is that the regulators, NAAC, put out what they felt was a equitable way to show and demonstrate the future forecast of an illustration, of a projection. And that was manipulated by the use of some certain ways in which carriers adjusted to that. And they felt that there needed to be a level set. So the one carrier out there added additional costs with additional multipliers to leverage it up. Now, let me explain what that means specifically. If you're dealing with a 5% charge and you're getting a higher multiplier, that's a great thing, especially when you have a good S&P return. It's a marvelous thing. But as I've sold for many years, and those are the people that sell on this call will know what I'm talking about. The minute you walk out of that interview, how much does your customer remember from what you said? How much do they remember in your first anniversary, your second anniversary, your fourth anniversary? And things have gone real well in the S&P. But in the fourth year, 0 is what you get. Well, it's a negative 5%. So they're going to be calling you when they look at their statement and saying, what is this? I lost money. I thought I was going to lose money on this thing. I lost money. So the case is you need to make sure that they understand that in 0 years, 0 is not your hero, negative 5% is your hero. And that's a lot when people don't remember what it is that they may have been sold later on. And so it's a very aggressive thing. And again, I say to my producers, if your customer understands money, really understands money and understands the leverage points that being in this type of investment is about, only would you ever show them an enhanced situation if that were the case. 99 and 44% of customers just need a 2% charge is fine. With a nice multiplier, that's great. Or if you don't want any multipliers, we have that option as well. But to get into those very large leverage points, where does it stop? What if I give you a 10% charge with an amazing multiplier? I mean, are we buying life insurance anymore here? Are we speculating? What are we doing? So that was kind of the thing where I think it was going. And they wanted to throttle it back. Appreciate
that. And one last question, you'd mentioned the idea of selling off the illustration. How can an agent put that into play? What kind of resources are out there for agents to really get educated on this so that they're maybe not as reliant on showing pie in the sky dreams and more a realistic forecast of what to expect.
Well, one of the things that there's an option that we have, which I kind of consider the training wheels of index universal life. When I find individuals that have been big whole life believers for many years and work in the traditional, whole life world, and they have to make the transition to an index product, what are we saying? In a permanent mutual life insurance company, what are you invested in? The majority of the investments are in bonds. So you're getting a dividend that's based upon ultimately bond returns. If you're buying an index product, you're in what market? You're in the equities market. You're in index, but you're in an equities market. So you have bonds if you're buying whole life insurance. You have equities if you're buying an index product. So if you're going to be in that index market, in that market, if you take a look at our high par, what we're going to do is we're going to take whatever the S&P return is, and we're going to enhance that return by a participation rate of 160. 140 is guaranteed. So we're going to take that 3% return, and if you look on any illustration in 2006, you'll see that the return in the market was 2.98%. So we would take that 2.98% and multiply it times 1.60. And that gives you a return. And then on top of that, we add another multiplier. So it allows you to be able to look at getting a modest return in the S&P and having a participation rate and a multiplier to enhance that rate to get to over 7%. And you'll see that in actually our illustrations when you look at the boxes that show what that particular investment would have looked like had it been in the markets for the last 20 years.
Hmm.
So it allows someone that has not really gotten into the index market to use high par as a very conservative way in which to get involved in the market and not be wild and crazy about it. And that's part of the education. But again, there's no manual to do this, and that's the sad part, but there's best practices, and you really need to understand it. If any of your listeners want to call me, I can walk them through a very sound, practical illustration on a white paper that you can, write out in front of someone to visually show them how this works. Illustrations are very helpful, don't get me wrong, and we utilize them for a great deal. But if you put it aside and you had to explain it to someone, could you do it? Could you do it effectively?
Well, Doug and Zach, real quick, I want to open this up. Does anyone have any questions specifically for Doug and Zach? I think, Doug, you said we can reach out to you directly. So I want to give people now the option to ask any questions, or Doug, if you can provide your contact information.
Okay, let's see if there's any questions first.
You can either drop a question in the chat function, or you can raise your hand, and I'm kind of scanning right now. All right, it looks like everyone is well informed now. No questions.
I think there was.
Stephen,
did you have a question? I think you're muted. Give me 1 second. You should be able. There you go.
Oh. Stephen, I think you got muted again by accident one more time.
How about now?
Nicole, you wanna?
Yeah.
Can you hear me?
Yep,
Yeah.
there you go.
All right. Has Hancock thought about using illustration software that also shows the effects of like Monte Carlo random sequence of returns, just giving a client an appreciation of what the possible outcomes could be versus using a static income every year?
Yeah, so we haven't, Monte Carlo is the one that comes up probably the most. So we haven't thought about designing necessarily that. What we do encourage, and we actually have marketing material around that, is essentially throwing in like a couple of years of zero here and there. I think typically usually there's like 2 or 3 zeros every decade or so, if we look like back historically, like when the market's down. That's sort of why we like that one. I think our product holds up really well there. But definitely we encourage, clients to stress test and not just use like a flat rate. That's the best way to understand like how it's going to perform if you want to understand that.
The reason I mention it is because when agents do this on their own, they may get it wrong, or as far as the formulas, crediting methods, bonuses, you know how complex these things are. But also, I think they subject themselves and maybe the carrier to liability later, because if it's not done right, or if there's a separate non-approved, non-SMRU projection used showing a higher rate or a different rate, or trying to emulate what I'm talking about. I'm aware of cases where insurers have been held liable for the conduct of the agent, even though it wasn't their document and wasn't authorized by the company. So it seems to me the safer course for the company is to have their own and say, here's a Monte Carlo analysis. Again, it doesn't predict performance, but this is actual returns back tested as opposed to using an average return. If you took 100 iterations or 1,000 iterations, here's the range of possibilities over the last 65 or 25 years. Then the client can see, okay, here's, even with the costs staying where they are at the current assumptions, I could still have to pay more premiums, or I could have quite a bit fewer premiums, at least give the client a better feel for what they're buying into, which is obviously much less of an issue with fixed products.
Yeah, and I agree with you. I don't know, though, again, we haven't put that together, but we've definitely thought about it. And again, Monte Carlo is the one that comes up the most, but yeah, we definitely encourage the stress testing.
Stephen, I couldn't agree with you more, and I appreciate your question very much. You're correct. There's a lot of misunderstanding and so forth. Now, for those so we're make sure everyone understands his question. A Monte Carlo simulation differs from the normal illustration in that when we show a static interest rate of 5.67 for the next 30 years, what's the chances of that happening? None, okay? What he's referring to is the fact that we actually go back and look at what the actual returns were in every year and model that out to see what it looks like, the pluses and minuses, and actually get a return based on what the historical changes were versus a static future just the same. NIAC regulates how we do this within an illustration. Now, carriers then have to look at whether or not they want to provide such a type of look back or other issue using Monte Carlo in that, and whether that harms or helps the discussion, because it's again, it's we're limited. What I would suggest is this: in every single illustration, including our own, you're going to see a box which has the 20-year look back. And it's NIAC's, I think, attempt to try to show you what you would have earned had you been in that particular account. But it doesn't do what you're saying on the Monte Carlo, and I agree. But it's, and we get this kind of thing all the time. Could you show me? The thing that I'm concerned about is that because you can't illustrate like we once did, agents might take it on their own to try to forecast what this would look like by putting a spreadsheet next to our illustration. And that would not be compliant, and that would not be good. But in an effort to try to show the leverage points that can be created by this product, they might want to stretch the limits of an illustration and do something off balance sheet to do that. And that's certainly a concern. But we understand your question.
That's exactly my point. I made that comment earlier. Is that I've seen agents do that. I've seen them. I'm an analyst. I also do expert witness work.
Okay.
I've helped protect sales that should happen and unwind ones that shouldn't have happened. And I've helped, agents as well as policyholders. So these are the issues that I see, especially with premium financed IUL. I've got a call today. I got a call today in a multi-million-dollar case. A client bought a policy 3 months ago. Now he realizes he should get out of it. So I'm being retained in that case. And the insurance agent at New York Life is going to probably get the business because he's offering a conservative, unleveraged product, which doesn't have multipliers and undisclosed caps and premium charges for all these things. As you may know, well, and another point is that why doesn't Hancock and other carriers provide the, what do you call it, the supplemental accounting ledger as a requirement, which shows the policy charges? The accounting of the contract, which shows each charge, the charge for the multiplier, the charge for the COIs, the charge for the base policy fees, et cetera, because that I think would really help and protect the companies and the agents on disclosure issues.
Zach?
Yeah, that's a good question. I think it's actually starting to move that way because of, honestly, the leverage, the higher charge IUL. I think there might be one or two carriers who started to dip their toes in there. But I think it will take, honestly, it'll probably take the states probably requiring that. Just because I don't know that every carrier will follow suit. I think that's, I agree. I think it would be beneficial for the clients. Right now, nobody really does it. So I think it would be sort of one carrier would have to take the first step and start doing it.
Well, Hancock's a good company, so I think they might be a good first step, because if you look at cases like you versus like the old PDX version, you had, you know about the case that was filed, the Lee case, the big one?
Yeah.
Class action. I'm working on that case. I'm one of the non-disclosed experts in that case. So that's a great case where a client is not shown, they've shown a better return, and they don't realize that the charges are 3 times that of like a Hancock IUL for a similar contract, but it's hidden by the multiplied performance. So the client never sees it. So I think that would really help in competitive situations for products like Hancock's.
Like I said from the beginning, we need to make sure that customers understand what they're buying, whether it's New York Life, Hancock, or anybody else. Disclosure is important, and there are 2 forms of it: errors of omission, no commission, and omission. And
Right.
what you don't say is as important as what you do say. And so that's why disclosure and those factors are very important in the sales process. I couldn't agree more. We're coming up on the hour here. Are there any other questions? Because I don't mean to cut you off, but I want to abide by the time that we were given here. Anything else?
No, Doug and Zach, I think we're good. Stephen, really, really do appreciate your perspective and what you said there. Doug, how can people reach out to you directly?
Okay, I can be reached at area code 949-230-0399, or you can reach me at DOUG_KOCH@jhancock.com. I'll send you a little flyer here that we have that talks a little bit about the things that we talked about, so you can forward that on to everyone, and I'll put my contact information on that. But this is a great little piece that it describes some of the main things that we're talking about.
Okay,
Thank
great.
you for having us.
Doug, that's great. I'm dropping your email address in the chat function right now. If anybody wants to take a look at that and copy that. Of course, you can reach out to us at Watermark Life at any time. We can facilitate any conversation on our end and obviously answer questions as well. Nicole, anything that you wanted to chime in with?
Nope, all good. Thank you everyone for being here today.
Right. Yeah, we really appreciate this. Doug and Zach, again, these are complicated topics, and to get a little kind of bird's eye view of what we're looking at, I think is really important. So we're glad to bring everyone together today. We will follow up with you guys shortly with any other presentations that we're doing to close out the year. And Doug and Zach, again, will be in touch with you. And if there are any co-brandable materials, Doug, real quick, you'd mentioned that there might be some materials out there.
Yes, on vitality and other things, correct. We'll get those for you.
Yeah, perfect. So if you guys are interested in any kind of co-branded materials or anything that you can help print out or email on your end to send to clients directly, reach out to myself. You can reach me at John with no H, Jon at watermarklife.com. You can also reach us anytime at info@watermarklife.com. Again, thank you all so much for your time. Doug and Zach in particular, thank you. And Nicole, thanks again so much for your time.
Thanks everyone.
Bye. Thanks, everyone.
Thank you.
Okay.